Hello and welcome to the Teachers for Intermediaries webinar. Thanks for taking us down and viewing this. My name is Ralph Punter. I'm the BDM at Teachers for Intermediaries. The purpose of this webinar is to update you or refresh your understanding of a number of positive changes that have been introduced over the last year or so. And by the end of the webinar, I hope that we leave you with a good understanding of the changes, share some practical examples of cases and where we may be able to help you with your more complex cases you may come across from your clients. Before I go through the slides, I'll give a quick overview of the actual webinar. Basically, we're gonna look at who the contact details are. There's two key propositions that we offer now as complex prime and teachers. We will predominantly be looking at the complex prime offering. We'll run through certain areas of the complex prime, how to deal with us, and then look forward to hearing from you with your queries and case scenarios. So first of all, we're actually a very tight team. This is the team of intermediary support. As you can see there, my details are just below there. Ralph Punter, Business Development Manager. By all means, you can contact me with any of your complex prime cases. But we're a very tight team. We're actually sit very close to different parts of the business as well, specifically the underwriting team. So when you do call us or you send us an email with a complex case, we can pretty instantly discuss the complexity and see if there's a solution that we can come up with. As mentioned, there's two key areas of our proposition. We do still have the specialisation of looking after the teaching profession, which I'll go through into later on today. But what's happened over the last sort of year to 18 months, we've developed and sort of looked at offering more complex prime solutions for the complex cases that you come across out in the marketplace. Four key areas that we're going to go through. So that's income, timing, property, and obviously age as well. All of these are sort of things that I'm sure you come across in either on their own, or sometimes you get a combination of an older client with a weird property and quite funky income. So we can look at those, and we're quite keen to be of assistance with those as much as possible. So first off, let's have a look at the income. So there's different sort of income is complex anyway. We can look at rental income, investment income, anything that's not your standard PAYE. Of course, we deal with that as well. But as people's work styles and work habits changed, and obviously the income sources change as well. For the older clients as well, we're quite happy to look at clients' pension income, and sometimes it's not always the case that the income is there in front of you. We might have a wealthy client with very low income, but their wealth might be in the form of investment portfolios, SIPs, or other forms of liquid wealth, which we at Teachers for Intermediaries may be able to monetize and turn into actual or theoretical income, so we can help a case get across on affordability. I'll talk a bit more about that later on. There is also the ever-growing self-employed population. No two set of accounts are the same, so we're quite happy to look at these cases on a case-by-case basis, looking for income creation out of those accounts. Sometimes it might be as straightforward as your director's salary and dividends, but quite often it's not. Quite often we need to look at funds held in shareholder funds, net profits. So we're quite happy and keen to look at any case that needs a manual view, a manual look, and sort of a human factor of looking at how can we actually make a case work. Going on to the older clients with complex income, as I said earlier on, we're quite happy to look at scenarios where clients may be approaching or already into their retirement age, they may be just taking out their state pension, but they may have desire, plans to do something, make their money work hard for them, make their property, their assets work hard for them, and they may have SIP values, even an ISA pot. These have been going for many years now, so there's quite a few clients out there that may have quite a large ISA pot that we may be able to monetize to create a short-term solution for a client. Moving on to timing. So what we're covering here is it's effectively an alternative to bridging lending. So we can do maybe a 1 to 5 year mortgage term. Interest only is available. We can take a variation of repayment vehicles. It may be the sale of the property itself. There may be assets in the background that we may be able to use as a repayment vehicle. The typical solutions that we look at are clearly the downsizing, or sometimes it's the upsizing solution, where they're ready to buy, they're really keen to buy the property that they've fallen in love with, but maybe not quite ready to sell the property that they're in at present. So that could be a downsizing, it could be it could be an upsizing solution. It could be may have a different scenario where there's a timing issue around disposal of assets, and it may be, again, maybe they're waiting to sell other property, maybe they're waiting to cash in on stocks and shares. So in terms of timing there, it might not be exactly the right time to cash in on a SIP, take their tax-free lump sum right now. So therefore they want to give themselves time in, but again, they actually still want to raise monies on a mortgage, be it remortgage or a new purchase. And it may also be a case of there's a short-term need to manage debt and manage tax planning as well. So there's a number of scenarios there, and I'm sure there's many other scenarios that you'll come across that maybe a client only requires a short-term solution. Typically that would be for bridging, but we can actually offer an alternative. Again, just to remind you, it needs to be serviceable, so the clients need to be able to meet affordability. These mortgages come with no redemption penalty, so they can redeem as and when. It's interest only with a monthly payment. And we're just keen to sort of assess each case on a case-by-case basis to see if we can be of an assistance. Give you a couple of examples here. Building retirement property. So yeah, 62-year-old, good income even at that age. They've got another property in the background, they've got savings. Yes, they could go down a bridging route, they could have used savings, but they were actually looking for quite a sizable borrowing of 600,000 on a value of 1.6. We got the building plan, so we could see everything that was going on. This isn't a self-build mortgage, but it's along the lines that we're creating funding for a client to do a building project, but not based on a self-build basis. We're basing it on an existing property and an existing asset. So in this scenario, we've clearly got enough income, but theoretically we may have been able to monetize anything else in the background. So maybe there's buy-to-let income, maybe even some of that savings, or maybe there's other solutions in the background. And on this case here, this is a real-life case. We did a 3-year term, no redemption penalty. So the client was in no rush. They've got plenty of time. And if they manage to get works done a lot quicker than they expected, then great news for them, because we've got no redemption penalty. They can also redeem that mortgage as well within the 3-year period. Another example here, basically looking to move closer to family, not really ready to sell up at the time, unencumbered, nice large property, and we're buying for just a smaller house and looking for a mortgage of 375. Good income. Again, the income in this scenario could have afforded and covered serviceability requirements on the mortgage. But also in this scenario, even if we didn't have that high level of pension investment income, we could have actually utilised the SIP. and actually basically created an income out of that SIP pot of £680,000. Generally, what we ask for there is one, the client or yourself as the intermediary obtains a statement from the SIP provider, generally given an idea of what the income can be drawn from that, and generally they come in at 5% or 7%. Ideally, we're not actually eating into the capital of the investment or the SIP, but on this one, we had the income anyway. Again, 2-year solution offered, no redemption penalty. Client raised the money. They've got 2 years in this scenario to sell their property. It may have been a case they just weren't ready to sell. They needed more time to sell. Maybe they wanted time to see what the market was, how the market was going to develop. Or maybe sometimes clients just like to gradually move into their new home and not have the rush of doing everything on one day. As we know, that's can be fun and games. There's other scenarios as well. Divorce settlement in this particular scenario, and they needed some payments to sort of get them out of their wedded scenario. The first payment was for deposit, and again we did a 2-year term. We bought them time so they weren't under pressure of creating funds and paying off monies in a very short period of time. Give you to some other examples. We've seen cases where bringing some of the headlines, so time in income and age. We've had a couple in their late 70s living on a unencumbered house with a large plot of land next to it, all under one title. In their late 70s, decided to build a new house that's more suited to their needs. Originally, their view was to go down a self-build route, where the build would be monitored. We've actually agreed to lend the monies required. We've also agreed to do tranche drawdowns, all within the first year. This client had low income, but in this instance, the client had a £600,000 ISA pot, as well as other investment pots. Solution we offered there, the client wanted £750,000, so we agreed £750,000 based on a 2-year term, and also with 3 drawdowns of £250,000. In this case as well, because the security was the main current residence, we're not interested in monitoring the build of the property, so there's no revaluations, there's no certificates required, so it's a lot easier for that client in that scenario. I also know that as of the 6th of March, we managed to see an updated build, so the property is now watertight, even within, I think we completed in December, so even within 3 months they've actually built the property in there. They're now ready for their next drawdown. So a great solution for the client, utilising the land and the title they've got, utilising not your straightforward income. We monetised an ISA, and also at a more competitive rates and a bit more flexibility for the clients as well. So going on to the subject of complex prime property, there's a number of areas here. So the first obvious one may be where your client is buying what was a farm, lots of land, lots of outbuildings, intend to live in the main house as a family home, and actually use the outbuildings for a number of reasons. I'll go into some scenarios shortly, but a few things to point out. We're not too worried about acreage. We don't have a maximum acreage that we will lend to. We're not too fussed about outbuildings. All we do insist on, and we do require, is that the main residential footprint of the property is at least 40%. We look at these on a case-by-case basis. So what we like to get is either call me or one of the team. Ideally, you've got a link to the property which has got a good description, a plan of everything that comes under the title. So moving on to what some of those outbuildings could be used for, we're quite happy if there's mixed use. So, we've recently had a case where we're lending to a couple and their children. They're moving into the house. There's 4 reasonable size outbuildings, 3 of which are going to be used as holiday let. One of them will be used for an office. So that one we've agreed to lend. I think we got up to about 880 on a value of 1.4. Utilise the income in this instance, so that's something we don't promote too heavily. We're also happy to utilise some of the forecast holiday let income to get the case across the affordability line. So again, that was family house, 4 outbuildings to be used as holiday lets and office space. We're quite happy as well if there's maybe a property with 3 floors and a basement. In this scenario, they're going to be living on the top 2 floors and the ground floor and the basement, maybe a buy-to-let, or vice versa. Again, so long as their main residential footprint is 40%. But yeah, that was another scenario. So yeah, mixed use is it's something we're seeing quite a lot, especially with the growth of holiday let, which I'll move to in a little while. But also there's lots of quite complex properties out there where maybe there's more residential use of what may have been solely commercial. Moving on, so holiday let is I'm sure you're aware, it's a growing marketplace. We're seeing and hearing of more either existing landlords or new to entry landlords looking at sort of investment in the holiday let environment rather than, or as well as, the buy to let. So our proposition, now we have policy here, but if you have something that doesn't quite tick the box, then please do give us a call. We're keen to explore and see if we can come up with a solution on even on cases that don't quite fit our own policy requirements. So for a purchase, basically we do stress test 135% of 569, and what we use is 30 weeks of the average of the low, medium and high. Typically a holiday let is pretty good yielding over and above that of a standard buy-to-let, so we don't normally see a challenge on the stress testing. Again, if we do, then we may be able to top slice, but there might be other income that we can use to sort of actually tick off the box, agree on a case that may initially look a little bit too highly geared. Remortgage, we can use up to 100% of actual rental received, and that could be evidenced either by bank statements or a statement from a letting agent, and that could be a holidaycottages.com. It could even be an Airbnb statement. Maximum LTV is 75%. Maximum age at the end of the term is age 83. Maximum loan here states 1 million, but as I say, any area of policy that isn't quite there or just doesn't receive a tick, then please give us a call. We're very keen to explore. So there are plenty of providers there, or growing providers out there on holiday let. So why would you use Teachers Building Society? Well, the basic answer to that is we look at cases manually. So by all means, please give us a call. We're not too worried if they haven't got a main residence. If it's an unusual property, if it's if the scenario that the clients have got below minimum income, then please give us a call for us to review. We also lend in the buy-to-let environment as well. Minimum income for a single applicant is 25,000 and 40,000 joint. Maximum 75% loan to value. Maximum age 83. The stress rate is typically 145% of 5.5 for a higher rate taxpayer, or 125% for a base rate taxpayer. So again, why would you use us? We're basically, again, we look at things manually. We're able to review cases on an individual basis, and we look for solutions. Things aren't straightforward nowadays, and we're not the tick box lender. So by all means, please give us a call with your complex cases. Again, top slicing is available. Unfortunately for buy-to-let, we cannot deal with portfolio landlords. whereas with holiday let we can. But again, give us a call with any scenarios where you need some support. Okay, so we've covered the complex scenarios that we can look at, and we welcome your cases and inquiries on those bases. The other obvious thing is that we were set up by Teachers Union back in the 60s, and so we are still very, very focused on supporting the teacher profession, specifically newly qualified teachers trying to get onto the market for their first time, just as they start their first ever job. So our 95% landing is ring fence for teachers, and we will end up to 5 times income for that scenario. Obviously subject to affordability. We also look at newly qualified teachers. We treat them as permanently employed. So majority of newly qualified teachers, their first ever contract would be a 1-year contract. They'll have no track history of working, and obviously they're going into their first ever job. None of that concerns us, and we're really keen to help as many newly qualified teachers as possible. And I believe there's around 38,000 newly qualified teachers entering the market every single year. So it's a quite sizable populace of new entrants to the market, and a fair percentage of those, I'm sure, would love to buy a house and live nearer to where they're working. Some of those may not believe that they can. So if you do get a newly qualified teacher scenario, then think about teachers for intermediaries. Supply teachers require a record of 2 academic terms, and we work affordability based on that. Also, again, for newly qualified teachers, they will start their job around the first week of September. We're quite happy for them to actually move into their first home up to 2 months before starting their new post. So it's around July. So again, they're getting settled into the area that they're going to be working, one thing out of the way, and then concentrate on starting their first ever job. We also accept up to 100% of additional teaching income used. It could be London allowance, it could be additional payments, responsibility payments. So again, sending payments, sending pay slips, and we can work out exactly what income we can use and how much they can borrow. We're quite happy to look at future and new contracts. We consider applicants on their new contract an increased pay rather than their latest pay slip, as long as it's within 2 to 3 months of them receiving an offer on their mortgage. We also accept Help to Buy. We work out the equity loan at 1.75%. Majority of lenders, I think, believe that work it out on 3%. So that may and it will often lead to a higher amount of borrowing capacity. We're then 95% on shared ownership. Shared ownership is only for a teacher profession. I will also go to remortgage debt consolidation for 90% loan to value. So as a recall, we are very keen to help the teaching profession. That was one main area, but the other key area is our complex prime solution. So that's a combination of income, timing, property, or age. Can I encourage you to register with Teachers for Intermediary? Go onto the website, look for the link for intermediary, and then register. It's pretty much instant, and then you'll get updates from us. And then when you do get that first case, then you're able to straight away use the broker portal. We'll make a point that the broker portal is only used for uploading cases for the complex prime business for security reasons. Otherwise, for any teacher, any standard cases, then yes, the portal we do offer a decision in principle and a full application process. One thing to point out is we do not credit score. So especially for newly qualified teachers or applicants with not much of a footprint, that can be quite helpful. So whereas an alternative lender that credit scores may offer less because the client has got a low score, we just offer whatever the affordability leads them to. So as a summary again, again, just to remind me, it's a small, tight-knit team, so continuity of contact. You will get through to one of the four there, and basically we do talk as a close-knit team, so there's a good handover whenever there's you need some urgent assistance. So please give us a call with any of your cases. Thank you again for viewing and listening into this webinar from Teachers for Intermediaries. Thank you.